Warren Buffett said it best when he said the quote, "It's far better to invest in a wonderful company at a fair price than a fair company at a wonderful price." Meaning that if you are putting your money behind really good companies, your chance of success is exponentially increased. If you were confused as to what factors you should look for in a company before you invest your hard-earned money in their stocks, then this is the perfect video for you. Hi, I'm Andrew and welcome to my channel. I'm here to talk about all things personal finance, career development, and investing. So if those are topics that interest you, please subscribe to my channel and be sure to look out for my weekly videos. I know your time is valuable, so let's get straight into today's video. Today, I want to cover how I pick the stocks that I have in my current share portfolio, and I want to provide you with the actionable tips and resources that you need to be able to make good financial decisions with your hard-earned money before you invest in a company's stocks. I'm going to talk through 4 metrics that I look for before I invest in a company. I'm going to list them here with the timestamps, so please jump around to the content that's most relevant for you. The first factor that you should consider before you invest in an individual company's stock is the company's competitive advantage. Now, this is the most common sense of all the factors that I'm going to talk about today, but it's also the one that's the most overlooked. And I think the reason is that when you look on a company's website, when you look in their stock earnings reports, when you look at their current share price, you're not going to see a competitive advantage score. This is something that more needs to be understood by yourself as a consumer or yourself as someone who understands the industry that they operate in. Point blank, for long-term investing success, you need to put your money in companies that are going to be around for a long period of time. And I think that makes sense. If a company doesn't have a strong competitive advantage, then they can be outpaced by competitors, they can lose market share, and their overall value and share price will decline over time, meaning that you're not making the returns that you set out to make by investing with them in the first place. Warren Buffett said it best when he said the quote, "It's far better to invest in a wonderful company at a fair price than a fair company at a wonderful price." Meaning that if you are putting your money behind really good companies, your chance of success is exponentially increased. This is the baseline factor that you should be looking at. Am I putting my money in a company that I think is going to be around for a long time and keep making money for a long time? Let's take a look at a few businesses that have really strong competitive advantages in the industries they operate in. The first is Facebook. Now, everybody knows Facebook, and by proxy, their subsidiary Instagram. So Facebook and Instagram are the biggest social media platforms on the planet, and the competitive advantage that they benefit from is called the network effect, meaning that the value of their products is basically the amount of people that use them, which again makes sense. Everyone has family or friends or colleagues that are using either of these platforms, and it almost feels like a necessity for you to also be on them. And so what this does is that it puts them in a position where they are far and beyond outpacing their competitors because they have such a volume of people using their products. And so let's say a social media app like TikTok rises up in the ranks, it is hard for them to steal share from Facebook and Instagram, because if I'm using TikTok, I'm not going and deleting my Instagram account or deleting my Facebook account. I'm just adding TikTok to the mix of my social media. So what this means is that I personally, and a lot of people agree, can see these products being around for a very long period of time. And I can't actually see a medium to long-term future where we don't have either Facebook or Instagram dominating the social media game, which is a good sign to assume that they will be around for a while and that advertisers will continue to spend money with them to be able to reach their mass audiences that use their products. The next company is Disney. Now, no matter where you are in the world, everybody has heard of Disney, or at least one of its more iconic fictional characters, whether that's from Mickey Mouse to Star Wars to the Avengers. Disney benefits from the competitive advantage of patents and intellectual property, which again makes sense. There is no shortage in this world of fictional cartoon characters in shows and the media. However, Disney far outpaces its competitors in terms of brand recognition and love for its characters. And because it has the exclusive rights to this intellectual property, every single time anything in the Disney franchise is used, they get paid a substantial amount of money in licensing fees. So think about it, every time there is a new TV show, a new cartoon, a new movie, a new theme park, a new merchandise set, or even a new fashion line like the one that was released with Gucci, Disney is sweating its equity and its intellectual property consistently and building a brand that is almost a juggernaut at this point in terms of brand recognition and love with the world. It doesn't seem to me that anyone is even coming close, considering the fact that they also continue to purchase other companies, like when they purchased Star Wars and when they purchased Marvel. Disney also owns a bunch of media companies like ABC and ESPN, and with releasing Disney Plus, they are actually becoming a massive media empire to then sweat their equity and sweat their intellectual property across all of these different media channels as well. The next factor that we're going to look at is called the price to earnings ratio, which is going to tell you the value of a company's stock in comparison to its earnings, which is incredibly valuable to know when making an assessment as to whether a company is a good investment. Essentially, the calculation for this is a company's share price divided by its earnings per share. Now, investors use this because they want to have an apples to apples comparison between companies to be able to understand how profitable and how valuable this company is, which makes sense because the stock price between companies, for example, Amazon stock is about $3,000, Google stock is about $1,500, and the amount of shares that they have available to purchase is also vastly different. So this ratio gives a very consistent view between companies on how profitable they are based on their current share price. This is important because even a great company with a great competitive advantage could be considered as overvalued at this moment in time. Maybe it's due to hype, maybe something happened in the market and people getting really eager and driving up the price of their shares. But it's really important to understand that even the best companies sometimes are quite overvalued for that moment. And this helps you understand and keep you true to what you are paying in terms of how much they are making and how much they're expecting you to pay for an individual stock in their company. A high P/E ratio means that investors are willing to pay more in this moment for that company based on its share price because of the promise of future earnings. These investors that are still buying when it's a high P/E think that they will make their money back because of the long-term gains of this company, and they are confident that it will succeed. Roughly, stocks in the S&P 500 have a P/E ratio of about 12 to 15 times, meaning that the value of the stock is 12 to 15 times the amount of earnings per share that that company is producing. So if there's something that is higher than that, you know potentially it may be overvalued, and if it's lower than 12 to 15, you know that it may be undervalued, and it may be worth looking into it to see if it's a relatively good deal because they are charging you less than the earnings that they are actually making compared to other companies on the S&P 500. An easy way to check this is on the website morningstar.com. You're going to want to type in the company's name, find the ticker symbol for that stock. For Google, it's GOOG. Toggle over to the financial section for a quick breakdown of all their profitability ratios. And for Google, their current P/E ratio is 30, meaning that its stock is trading at 30 times its current earnings, which is relatively high. So this means that if you are currently purchasing Google, there is a relatively high charge based on their earnings per share, and you want to be sure that you will make this long-term back from this company. So this means that if you are buying Google shares right now, you have to have a high confidence that they will make this money back over the long term based on them wanting to charge you more for their earnings per share as it currently stands. So it's good to note that it's not a complete deal breaker that they have a high P/E, but it's something to look at and understand and really ask the question, are they overvalued based on what they are making right now? And can I be sure that they're going to be making a lot more money in the future to make up for this high cost? The next factor we're going to look at is profitability. How much money is a company making over and above its annual expenses? Now, a great metric that you can easily find to be able to determine a company's profitability and how good they are at making money is called return on capital. And this is going to tell you exactly how much money a company is making in relation to the money that it is investing in order to then make those profits. Let me talk about this a little simpler. If a company made $1 million in 2019, but it spent $10 million of capital investment to make that $1 million, then the return on capital for that company would be 10%, which is okay. It's good actually, but it's nothing to phone home about, and it's not amazing and extraordinary and is going to get me to want to buy their stock immediately. So what this metric tells you, which is return on capital, is that this company can make more money with less resources. Essentially, how good is this company at making money? So for me personally, for my portfolio, I look for individual stocks that have a return on capital of about 15% or higher. This is generally average of what you should be looking for, and what I would recommend is that if you see a return on capital on 5% or less, or even negative, I would seriously question as to whether this stock is good for you to invest in this time. Maybe something volatile is happening with the market, maybe they're investing for a really massive push in growth in the future. Who knows, dig a little deeper, but I would always caution you to look at the companies that have less than 10% and understand if they're right for you. As I mentioned previously, you can also use Morningstar in order to find this ratio for any company that's traded on the stock exchange. So let's use Google again as an example. As we can see, their current return on invested capital is 15.5%, which is great considering how fast the stock price is already growing. The moral of the story with this one is invest in companies that are good at making money with as little as investment as possible. And finally, for the dividend stocks that I buy, I always want to look into the stability and security of the dividends that are being paid by that company. And you definitely will want to look to this as well, especially if you are relying on these dividends for passive income. Now, the easiest way to find this information about the stocks that you want to invest in is on the website simplysafedividend.com. This is going to provide you a dividend safety score for the stocks that you're looking at. It's going to let you know the likelihood that that dividend continues to be paid out, as well as the likelihood that that stock and dividend will increase over time. It also provides information from analysts as to whether they recommend that you should buy, hold, or sell the stock that you are looking at. However, this is a paid service, so it's not right for everyone, especially those of you who are on a budget and just starting investing. So I do have a free alternative to help you find the basic information on dividend security to be able to invest confidently for dividend stocks. First, you're going to go onto dividend.com, where you're going to search the company that you want to invest in, and it's going to tell you a bunch of really important information about that company's current dividend and their dividend history. So let's go and look at an example for Johnson & Johnson. First, it's going to tell you their current dividend yield, which for Johnson & Johnson is at 2.51% per year, which is strong because it's outpacing the inflation rate of about 2%. It's then going to tell you the dividend frequency. So here we can see that they pay their dividend quarterly, so you can expect a payment every few months. And finally, and most importantly, it's going to tell you how many consecutive years the dividend has gone up, which for Johnson & Johnson is 24 years. And this last metric specifically is so important to look at because it's going to tell you the history of that company. And for Johnson & Johnson, they have paid out a consistent dividend for 20 years, and the amount that they've paid out in that dividend has grown every year for those over 20 years. Even through turbulent times like the global financial crisis, which happened in early 2000. So what this does is lets you know with confidence that this company has survived previous economic crises, they've always paid out a dividend, and I can be assured that I assume that they will continue to be able to manage volatility in the market and pay me my dividend. And that has been a whistle-stop tour of the 4 metrics that I look at when I'm looking to invest in companies and add them to my stock portfolio. If you are still watching, thank you so much. Please leave a like and be sure to subscribe to my channel. It's free and it really helps. Now, if you haven't seen my previous video about beginner's guide to investing in the stock market, check that out as well, and let's keep our investing journey going together. that is all from me. Enjoy the rest of your weeks, and I will see you soon. Bye.